Good afternoon, everyone. Welcome to Changes in Lease Accounting Are Coming. Are you ready? The first program in Cohen & Company's 2021 Virtual Summer CPE series. Thank you for joining us. Before we get started, we would like to review a few housekeeping items. My name is Jennifer Novotny, and I will be your technical host for today. If you have any questions or challenges throughout the webinar, please send a message using the chat feature in your WebEx window and send your message to the host only. This webinar is eligible for CPE. In order to earn CPE credit today, you will need to be on the webinar for at least 50 minutes, and you must answer 4 out of the 8 polling questions during the webinar to receive full credit. The polling questions will appear on the right-hand side of your WebEx panel throughout the webinar. Because we have a number of polling questions today and a lot of information to cover, you will have approximately 45 seconds to select your answer once the poll is open. Please note the polling questions will appear in the presentation slides for your reference. Please be sure to hit submit once you have answered the question. At the end of the program, a survey will automatically appear. So please take a moment to evaluate the session as your feedback is very important to us. Please submit questions through the chat feature in WebEx to all panelists. We will try to answer as many questions as possible and will follow up directly regarding any questions we are unable to get to in the time allotted. We are recording today's session, and the recording along with a copy of the materials will be available on the Cohen & Company website later this week. Please note, CPE credit is not available for watching the replay. CPE will only be awarded for those attending the live presentation. I would now like to turn it over to our presenters for today, Jamie and Brian. Thank you.
Thank you, Jennifer. As she said, the title of today's session is Changes in Lease Accounting Are Coming. Are you ready? We felt like that was a timely topic for this summer, as given the multiple delays in the effective date of this standard, it may be tempting to some people to continue to kick the can down the road in terms of dealing with the pending implementation of this standard. If you take one thing from our discussion today, it should be that doing so would be a big mistake. Before we get into the content today, I'd like to do quick introductions. I'm Jamie Blake, and with me today is Brian Fiedler. We are both partners in the firm's assurance department. You will see the learning objectives for today listed on this slide. Keep in mind that we only have a short time today. Because of that, we will only be able to cover the standard from a high level. Our goal, after giving you that overview, is to focus our time on the significant impact. We will illustrate to you the impact the standard will ultimately have on financial statement presentation and disclosures. In addition, there are some decisions you will have to make upon transitioning from the old rules to the new ones. We will briefly touch on those. We will also point out some areas that we believe could cause challenges during implementation. Then ultimately, we want to leave you with some thoughts on what you need to do in order to adequately prepare for these changes and how we can help you if you need any assistance. As a backdrop for our discussion, I just want to provide you with some brief background information. These changes to how leases are accounted for have been a long time coming. The final standard took nearly a decade from initial discussion to finalization. Finally, in 2016, the standard was issued in its final form. Since its issuance, there have been numerous amendments as well as 2 deferrals of the effective date, and there is another change out there right now in proposed form. Regardless of whether you agree or disagree with these changes, they are here to stay. Standard setters believe that these changes will better reflect the rights and obligations arising from leases, will align the accounting treatment more with the foundational principles of accounting and financial reporting. Ultimately, this should improve the understanding, transparency, and comparability of financial statements and result in fewer opportunities for entities to structure leasing transactions simply to achieve a particular accounting outcome. Public companies implemented this new standard for years beginning after December 15, 2018, so calendar year 2019 statements and later. In the past, it has been common for private companies to be required to implement a year after public companies. But as I mentioned earlier, this standard's effective date for private companies has been deferred twice, most recently to give companies more time to deal with ramifications of the pandemic. These delays have given private companies a tremendous opportunity to learn from public company implementation and leverage that to their benefit. You should not expect any more delays. I guess if we learned anything from 2020, it's never to say never, but barring some crazy unforeseen event, private companies will have to implement this standard for the 2022 calendar year or fiscal years ending in 2023. So if you have not started your implementation considerations, the time is now, with the effective date of January 1st, 2022, quickly approaching for calendar year entities. Early adoption is permitted, and we have had a handful of clients implement already in their 2019 or 2020 financial statements. That leads to our first polling question, which is, have you early adopted or do you plan to early adopt the new lease standard? So your choices here are yes, already adopted, yes, plan to early adopt, or no, will adopt when required. We'll give everybody a little bit of time to answer this question. We'll see if the results are what we expect to see.
And I know, Jamie, for my client base, most are waiting for when it's required to actually adopt. I only have a few that have selected early adoption.
Yeah, that's what I'm expecting. We'll see if there's any surprises from the results. Okay, so as we expected, most people say they will adopt when required. Piggybacking off of that question, we have a follow-up polling question. So where in the implementation process are you? So maybe you haven't adopted, but have you started thinking about it? Maybe you've gotten a lot of the way through the process and you're almost ready, or if you've already implemented, there's a choice for that too.
Again, Jamie, I think for my client base, a lot of my clients are starting to think about it, or they have started to think about it right before it got delayed over and over again. So they're in some part of the process, but not quite fully ready to implement at this point. So
I agree. I think you're going to be right on, and where most of the responses are going to probably be in that category.
Yeah.
Brian, if you want to go on with the content, you can do that. And okay, yeah, so we're in between haven't started and started thinking about it.
Yeah, great. So as we start talking about the new lease standard and what this is going to entail for all companies that have leases, I wanted to get some basic terminology out of the way. The primary focus of this presentation is going to be on lessee accounting. So I wanted to get out some basic terminology on lessee and lessor. The lessee is the entity that's going to enter into a contract to obtain the right to use an asset, right? So they're the ones that are trying to get use out of an existing asset. And the lessor is that entity that's, that enters into a contract in order to provide that right to use, the right to use that underlying asset. The main crux of the difference between the old rules for leases and the new rules is the idea that on the lessee side, all qualifying leases are going to have a right of use asset and a right of use liability recorded on the balance sheet for them. So no longer will there be this off balance sheet accounting and disclosure of future obligations underneath existing leases. So when you enter into a lease, you're going to record an asset and a liability. The asset is going to represent the lessee's right to use that underlying asset for the lease term, whereas the liability is going to represent the obligation to make those lease payments arising from the lease, measured at a discounted basis. So So there's going to be changes in, presentation in the footnotes as well as on the face of the financial statements, which is going to be a big change. Again, sticking with some of the basics here, defining what a lease is underneath the old standard and the new standard. The old standard, as you see here, is fairly generic in terms of its definition of what a lease is. It defined it as an agreement conveying the right to use property, plant, or equipment, usually for a stated period of time. So very vague, open to interpretation. The new definition, while still not very specific, does call out and has some new ideas associated with it. Those new items we have highlighted in blue here. So wanted to spend a little bit of time on this, just making sure that we all understand the new nuances, with this definition. So underneath the new definition, a lease is going to be a contract or part of a contract that conveys the right to control the use of identified property, plant, or equipment for a period of time in exchange for consideration. So, digging into this a little bit further, start with the right to control. This is new to the definition, and it really goes to show, who has substantially all of the rights to the economic benefits from the use of that asset. If that entity with control is the lessee, then you're going to have a lease. If that entity with underlying control is the lessor, that contract won't be accounted for as a lease. This definition also gives the idea of, as highlighted in blue here, an identified asset. Typically in lease agreements, the item being leased is specifically identified, whether that's a building or a vehicle or some other piece of equipment. Occasionally, though, leases are written in a way that you have a generic use of trucks or rail cars or other pieces of equipment, and there's nuances within the definition and the guidance that talks about whether or not those types of agreements actually have an identified asset or not. So understanding those nuances and going through your agreements to make sure you have an identified asset is going to be an important part of applying this new guidance. And the last item that we wanted to touch on was this idea of a contract or part of a contract. This brings to light the idea of an embedded lease, and it's typically we're used to seeing contracts that say lease agreement at the top of it, right? That's very easy for us to say this contract is a lease agreement. We're getting the rights to use an underlying asset. As contracts have evolved over time, and your vendors are providing you services in different ways, you may have to look at some of your underlying contracts that you're not currently accounting for or disclosing as leases to determine if they actually do contain a lease. Some quick examples are any supply arrangements that you have, where you may have a bundled service and an underlying device. Outsourced manufacturing is another example. If you can ultimately control the underlying piece of machinery that's producing the parts for you, it is an example where you might have a lease. And also, data center arrangements. Who's controlling those underlying assets at the data centers, and which you're storing and using for data transfer. So something to consider, and that leads us kind of into our next polling question. In regards to embedded leases, do you have concerns that you may have embedded leases not currently identified as a lease? And kind of what I take that as is, currently you have footnote disclosures in your financial statements that say, here are the future maturities of my leases. Whereas underneath this new standard, you may have to consider other contracts that aren't currently, that you don't currently have separated and disclosed in your financial statements. So just curious if the audience out there has any concerns with, additional embedded leases. So most said no. I think for my client base, I would tend to agree with that. I think a lot of my clients may have embedded leases, but it may be a matter of materiality and if those leases are material. one other item that we wanted to talk to you about was this idea of the criteria for classification of leases. Again, this is on the lessee side. There are 5 criteria listed here, and underneath the old standard, you had operating leases and capital leases. Operating were not recorded on the balance sheet. Capital leases were. Underneath the new standard, operating and financing are both going to be recorded on the balance sheet, and you need to really determine the classification, whether it's operating or financing. Now, initially, you may think, hey, if they're all on the balance sheet, why does a classification of operating or financing matter? Jamie will actually get into it in a little bit. There are some accounting differences, that need to occur depending on the classification. So these criteria are important to know and understand. And going through this, rather quickly, because we don't have a ton of time on today's call. Starting with ownership transfer, if the ownership of the asset transfers to the lessee, typically at the end of the lease, that would kick it over to a finance classification. And so if the answer to any of these are yes, your underlying lease is going to be a financing lease. If there's an option to purchase that the lessee is reasonably certain to exercise, that would also kick it over. If the present value of the lease payments is equal to or more than substantially all of the fair value of the underlying asset that you're leasing, that would also kick it over to a finance lease. And then your lease term, if you're leasing the asset for a major part of the economic life, if you're leasing a building for 40 years and the underlying economic useful life is 40 years, it's going to be classified as financing. And then finally, specialized nature. If the underlying asset is expected to have no alternative use to the lessor at the end of the lease, basically they can't take that asset back and then release it out to another party. This is also going to be forcing the lessee to classify it as a financing lease. So some things to consider, as I noted, your leases will be accounted for as operating unless you meet one of those previous criteria. And some things that are new and a little bit more difficult to ascertain with this new standard is the old standards or the old rules had some bright line tests. They provided percentages when you're looking at lease payments compared to the fair value, or instead of saying the major part of the economic useful life, there were bright lines and percentages that you could look at. There are no more of those bright lines available for companies to rely on. Now, you can still look at those as reasonable, but that just goes to show that judgment will play a more critical role in determining the classification of leases underneath this new standard.
Brian touched on this a little bit already, but this slide shows you the impact of both finance leases and operating leases on the financial statements. Both types of leases will result in showing right-of-use assets and lease liabilities on the balance sheet. For finance leases, this is similar to how capital leases are shown currently. The big change in this standard is for operating leases, as currently these are off balance sheet, as Brian said before. Under this standard, if it qualifies as a lease, barring meeting the short-term lease exception or the lease payments entirely consisting of variable payments, the lease will be on the balance sheet. One thing to point out in terms of balance sheet presentation is that right-of-use assets and liabilities have to be shown separately, both from each other and from other assets and liabilities. This separate presentation can be handled on the face of the financial statements or disclosed in the notes. If not shown on the face of the statement separately, you must disclose which line items they are included in on the balance sheet. Right-of-use assets will be considered non-current, and lease liabilities could be current or non-current, or both, based on the timing of the amounts to be repaid. In terms of the income statement for finance leases, there will be two pieces of expense: interest expense on the lease liability and amortization expense on the right-of-use asset. Again, this is similar to how capital leases are currently accounted for. These amounts are not required to be presented separately. on the face and should have presentation consistently with how you show interest expense and depreciation or amortization now on similar assets. The expense for operating leases is shown as one single lease expense, similar to how straight line rent expense is currently reported in the income statement for operating leases. On the cash flow statement, repayments of principal of finance lease liabilities will be a financing activity, as principal payments currently are of capital leases, and payments of interest on finance leases, as well as payments from operating leases, any variable lease payments, and any short-term lease payments, but will typically be included in operating activities. We have another couple of polling questions here. The first one is, how many leases do you have? We'll give you a little bit of time to respond here. Just kind of want to gauge where you guys are in terms of volume of leasing activity.
Yeah, and this is an important question because as you're thinking through the identifying the leases that you have and how much time it's going to take you to implement this new standard, under 10 looks a lot different than 50 or greater. So going to be varying answers here will produce different needs and how much time it's going to take to implement the new standard.
Good point. If I guess how this one's going to turn out, I'd say most would be in that 10 to 49. Oh, I'm wrong. Under 10. Okay, so our audience today has most of you have under 10 leases. We have another polling question for you. So how do you currently track and maintain your leases? I feel like Excel is going to be a popular one here, especially since most of you have under 10 leases currently in your lease portfolio.
Yeah, for a lot of my clients, Jamie, if they have under 10 leases, there's not a lot of tracking going on. They maybe have an amortization schedule that came along or they entered into a few years ago, but they're not doing a lot of hard tracking of some of this info.
Yep, makes sense. So that came out pretty much how we expected.
Yeah, and in line with how many leases the underlying participants have as well. So, which is interesting. The more you have, the third-party software or some other method is definitely going to be necessary. All right, so moving on, you want to talk about recording the underlying right of use assets and liabilities. On day one, it's possible that your lease liability and your right of use asset will equal each other, but that's not always guaranteed based on the economics and specifics of the underlying contract. So starting with the lease liability, you're going to record your lease liability as any other kind of obligation as a present value of the payments that you owe underneath that contract at a discount rate. We'll talk about the discount rate on the next slide, but in thinking through what payments you need to include, if you have an option, if you're leasing a building and it has options to extend, you would actually include those periods or those additional terms that you are reasonably certain that you're going to extend that lease out. So if you had a 10-year lease with an option to renew for another 5 years, if you're reasonably certain of exercising that, you would include 15 years of payments. Discount that and then do your present value calculation. That would be your lease liability. That's your starting point for calculating your right of use asset. And to that, if you have any initial direct costs, those costs that are incremental to you obtaining the underlying lease contract, you would add those to your right of use asset. If you had any prepaid lease payments or accrued lease payments, that could increase or decrease the amount of your right of use asset. And then finally, you would reduce the right of use asset for any lease incentives that you receive from the lessor. So typically you'd see these in lease build outs as you enter into a new facility and you need to do some movement around of the facility walls or structure to make it more useful for your company. So again, the lease liability and right of use asset can equal each other, but there are reasons why those amounts would differ as well. So going on to the next slide, this is where, you know, the calculation, there's important calculation considerations to think through, right? So unfortunately, this isn't a rote, you know, exercise where you have a fixed number of, you have known inputs and, you know, the exact discount rate that the lessor used, and, you know, determining what indirect cost rates can be capitalized and what lease payments to include. So I wanted to talk through a little bit of these to make sure you understand how, you know, how complicated or, you know, are items that you need to consider as you're going through this. So first, as I talked about on the last slide, you know, reasonably certain. If you're reasonably certain to exercise either the extension of a lease or the purchase of the leased asset, you know, how do you gauge whether or not you're reasonably certain? You know, it's meant to be reasonably certain is meant to be a high threshold, but you do need to take other items into consideration, such as you know, the uniqueness of the asset, the ability to find a replacement for that underlying asset. If you're talking about a facility, what's the cost of moving, and is that very prohibitive to you know, saying like, yeah, I'm probably going to be in this lease during those extended periods as well, or overall disruptions to the operations of the company. So items to consider there. You know, discount rate, there's for private companies, which all of you are, you know, there are some options. So typically the rate you use is the rate that's noted in the lease agreement. I don't know if I've ever seen a lease agreement that showed the actual rate they use to discount. So then you're down to calculating your own incremental borrowing rate, which can be a little time consuming. But you also have an election where you can choose a risk-free rate, and there's some pluses and minuses behind that. So unfortunately, there's not a set rate for you to use. There's options and considerations on either choice. You know, initial direct costs, what do you include? You know, lease payments. You know, lease payments, you know, are not always straightforward in terms of you owe me $100 a month. Sometimes there are variable payments. Sometimes there's fixed. Sometimes there's a variable based on an index. You know, the exercise price to purchase the asset, termination penalties. You know, what of those amounts do you end up including in your in those underlying calculations? That can have a big impact on your balance sheet, right? If you include everything, you know, that's obviously grossing up your balance sheet quite a bit. You know, lease term, how far do you look out? You know, nobody has a crystal ball, but you know, again, it goes back to that reasonably certain option. And then purchase options. You know, what if you don't know? You know, again, you only have the information that you currently have available today, and that's what you're going to have to use to make those underlying determinations. One more polling question. Do you expect to have a need for the use of specialized software to assist you in accounting for leases under the new standard? So based on some of the previous answers that we got that we received for these polls, I'm assuming most of you are going to say no, or maybe unsure, but there are a lot of software options out there and available to you that can help you know, ease the implementation of this and also the ongoing underlying accounting as well.
Brian, for the sake of time, I'm going to move on and we'll be able to talk about the answers to that polling question. Oh, here they are. No, so that's pretty much what we were expecting. So now we want to spend a little time covering some decisions that you're going to have to make upon transition from the old standard to the new, both in the transition method and with respect to policy elections and practical expedients that are available for your use. So let's first look at the transition method. ASC 842 requires a modified retrospective transition method. The standard provides two options in applying this transition. These are referred to as the effective date method and the comparative method. If you choose the effective date method, you will make a cumulative adjustment to the opening balance of retained earnings on the date of adoption, and then apply the guidance from then on. If you use the comparative method, you make that cumulative adjustment to the opening balance of retained earnings as of the beginning of the earliest period that you present in your financial statements and then you must apply the new guidance to both years that you present in the financial statements. So which method you choose impacts only when you apply the new standard, not how you adopt it. The recognition and measurement are the same under both methods, but the timing of that initial right of use asset and liability recognition for existing operating leases and initial preparation of the disclosures for leases will be different. You'll have to decide which method is best for your company based on your needs and the needs of the users of your financial statements. The standard as originally was issued only had one method of transition. In 2018, the FASB amended the standard to allow for the effective date method. This was added in response to concerns that the comparative method would be too costly and complex for some people to apply. One significant disadvantage, though, to using this new optional method is that when you're showing comparative statements, the prior year will be under the old standard and the current year under the new. This reduces comparability of the period and could be confusing to those reading the financial statements. Nonetheless, this is an option. To avoid this issue, you may want to consider whether issuing single-year statements in the initial year of adoption of the standard may be something that you prefer. Conversely, electing the comparative method might be more complex and costly to do, but if you need to show both years in your financial statements, it would make them comparable with both years presented and disclosed under the new standard, eliminating confusion on the part of the reader. This slide is a summary of all the transition practical expedients and accounting policy elections that are available to lessees under ASC 842. I'm going to go into most of these in a little bit more detail in the following slides, but this is one place you can go back to see all of them in one spot. I will start by talking about two of the practical expedients available in transition, the package of 3 and the hindsight practical expedient. We aren't going to spend time on the land easements one today because I don't think it applies across the board to all participants, but if it applies to you, be aware that it's out there and you should look into that more deeply. So beginning with the package of 3, this is called the package of 3 for a number of reasons. The 3 is because it contains 3 items that if you elect this, you don't have to reassess upon transition. Those are listed here, whether any expired or existing contract is or contains a lease, the lease classification of any expired or existing leases, and any initial direct costs for any existing leases. The reason for the term package is because this is an all or none option. It can't be applied on a lease by lease basis, nor can you choose 1 or 2 of the 3 items not to reassess. It's take it or leave it. If an entity does not elect this package of 3, the standard contains guidance as to the date that the classification of existing leases must be reassessed, and I have some information on the slide about that. From what we're seeing from public company implementation and surveys that have been done of private companies, we expect this to be a pretty popular transition election. In addition to the package of 3, upon transition, you are given the option of using hindsight when evaluating the lease term and impairment of the right of use asset. It also provides guidance on when you do that evaluation. This one can be elected on its own, or you can elect it with the package of 3. One important point to note is that if you elect both this one and the package of 3, you do not have to reassess the lease classification if hindsight results in a change to the lease term or the assessment of a purchase option. So it doesn't trump your other election. The use of the hindsight practical expedient, although it says it's transition relief, may create more complexity in some situations, although it is a more accurate measurement of right of use assets and the lease liabilities in transition. In addition to the transition practical expedients that are available, There are 4 accounting policy elections which a lessee may make. Those are listed here, and I will provide more details on each one of them in the upcoming slides. There's pros and cons, like Brian mentioned earlier, to each of these elections. So you'll need to consider the ramifications on your company for each one of these decisions. The first is that you may elect to not separate non-lease components from lease components to which they relate. Instead, you can account for them collectively as a single lease component. So a lease component is like a payment for the right to use that asset. So think of base rent. A non-lease component is for services performed by the lessor other than for the right to use that asset. So an example of this could be payments for common area maintenance. This accounting policy can be elected by class of underlying asset. So you could use it for one class and not for another. It can be used regardless of the significance of the non-lease components, but it's more unlikely that entities will use this if those non-lease components are sizable, as they will result in recording additional lease liabilities on the balance sheet. If you elect this policy election, you do have to disclose that you are doing so and which classes you are applying it to. Another election available is to account for leases at a portfolio level rather than the individual lease level. To do this, the leases have to have commenced at or around the same time, and the resulting accounting would not differ materially from doing so at the individual lease level. We expect companies to use this when they have leases that are similar in nature or similar underlying assets and have identical or nearly identical contract provisions. This next one is probably the most popular and certainly one of the most talked about. It is the short-term lease exemption. Under this election, a lessee may elect not to apply the recognition requirements of this standard to short-term leases. What is important here is what qualifies as a short-term lease. It is a lease that at the commencement date has a lease term of 12 months or less and does not include an option to purchase the underlying asset that the lessee is reasonably certain to exercise. If you elect this policy, it must be disclosed. And in addition, there are disclosure requirements for short-term leases. There have been some questions about the short-term leases and how those are handled in transition. One important point to make here is that a short-term lease is a lease with a total term of 12 months or less. This includes periods before the effective date of ASC 842. So just because there might be less than 12 months remaining on a lease as of the effective date, it doesn't make that lease short-term and exempt from ASC 42 recognition. Another policy that has gotten considerable attention is the one that permits private companies to use a risk-free discount rate instead of their incremental borrowing rate when assessing lease classification and measuring lease liabilities. As we talked about when we went through the basics of when Brian talked about the basics of the calculations, determining the rate to use could be challenging. To avoid those complexities, you may think that you should just use the risk-free rate to make the application of the standard easier. But before doing so, you need to look at the consequences of making that choice. The risk-free rate will likely be considerably lower than your incremental borrowing rate, which will cause larger lease liabilities and right-of-use assets. It could also cause what may have been an operating lease to be classified as a finance lease due to higher present value calculations, which could trigger the finance lease criteria, where the present value equals or exceeds substantially all of the fair value of the underlying lease asset. One additional item I want to point out here is that currently, if an entity elects to use the risk-free rate, it must use it for all leases. There is a proposed standard out there that, if adopted, will allow lessees to make this election by class of assets rather than at the entity level. This would allow more flexibility. So that is something to watch if you are considering electing this accounting policy.
And our next polling question is open now. And one thing to consider with everything that Jamie's just gone through, have you begun to have any discussions with your bank regarding expected impact on your financial statements and any impact on covenants as a result of this new standard? My experience has been some bankers are aware and have expected the overall impact, and other bankers are completely oblivious and have not considered the overall impact to the financial statements. So it looks like most of you have not started. Again, I take a look at your covenants with the bank and see if you do have any concerns regarding how your covenants may shake out.
Thanks, Brian. I just want to provide a general overview of the disclosures that have to be made under the new standard. First, you must disclose the election of any practical expedients or accounting policies used that I just talked about. If you elect the comparative method, the disclosures that are required for all periods that you present in the financial statements, all under the new standard. If you choose the effective date method, you will make disclosures under 842 only for the period after the effective date, and you'll have to carry forward all of the disclosures that were required under 840 for any comparative periods presented, as we discussed before. And one thing is, like under ASC 840, you only had to disclose the future operating and capital lease commitments for the last annual balance sheet that was presented in the financial statements. However, if you choose the effective date method on transition, you're going to have to make that disclosure as of the last balance sheet date prepared under topic 840. So this is where you can see how using the effective date method could make the statements and disclosures a little bit more voluminous and possibly a bit confusing. This slide provides a summary of disclosure requirements for a lessee. In addition to the disclosure relating to which practical expedients and policy elections you used, you have to provide information about the nature of the company's leases, information about leases that haven't yet commenced, significant assumptions and judgments that you made in the process, amounts recognized in the financial statements segregated between finance and operating leases if you don't already have that as evident on the face of the financial statements, and maturities of both finance and operating lease liabilities, and as also disclosures related to leases with related parties. Although not covering all the specifics of the required disclosures today, there are a couple key points that I want to make on those disclosures. Some of the requirements are the same as under the old standard, but there are new and expanded requirements. The disclosures are significantly more comprehensive, and you really need to tailor the disclosures to suit your specific leasing activities. Also, you're always permitted to consider both materiality and relevance when determining proper disclosures. We have another polling question. What do you expect to be the most difficult aspect of the implementation? We listed a few here: identifying leases, calculating lease assets and liabilities, evaluating transition practical expedients and policy elections, formulating disclosures, or maybe there's something else in the standard that you think will be challenging.
I know for my client base, Jamie, the answer to this depends on their underlying leases, right? So if they have very straightforward leases, the calculation of lease asset and liabilities won't be very difficult. If they have unusual contracts, like some of my technology and life science clients do. They may have embedded leases. So depending on the industry you're in, it may, or your situation may impact how you answer this question.
Yeah, I agree. We probably will get responses for all of them. Yep.
Yeah, probably our most even.
And that the policy elections is a considerable, got considerable votes.
Yeah. And we did have a question come in. Jamie, I'll ask this to you, and if not, I can answer. But can you use a dollar threshold for recognizing lease payments off balance sheet, similar to capitalization policy for fixed assets? And what would a reasonable dollar threshold be?
Yeah, so that's a good question, and it has been asked a lot on seminars that I have attended. And really, there isn't a de minimis threshold in the standard. The international standard on leases does have one, but when the U.S. wrote theirs, the FASB decided against that. Because materiality is already a concept, you're allowed to use materiality, but they didn't want to set a threshold. So that's the short answer. I really can't give you an exact dollar amount, but it absolutely can be considered, and you can make a policy yourself that you would like to follow for that.
Yeah, and for anybody that if you have a Pitney Bowes machine where you're paying $35 a month, that's probably not going to reach your overall thresholds, depending on the size of your company. If you have other leases that you're considering that you think may be bumping up against that threshold, and you have any questions, feel free to reach out to your audit or review team, or your financial statement accountant, to help you think through some of that. As we wrap up here, a few other items. We have some additional challenges in the new lease accounting. Again, we're not going to get into the detail on all of these, but identifying maintenance and other costs included in the lease. All the payments that you're making, you may have one payment stipulated underneath the contract, but it may be for more than the lease, the underlying lease of that asset. For example, common area maintenance, taxes or insurance. What other costs are included in the lease and how do you separate those, are going to impact the overall calculation. Variable rates and escalation clauses, right? So if your payment stream isn't fixed and your lease payments are variable, how do you consider which payments to include or to not include, and as well as escalation clauses, something to consider. Many of you may have deferred rent on your balance sheet right now to account for lease payments that step up over time. Those deferred rent amounts will go away, and ultimately, depending on what those step payments are based on, could impact the overall calculation of your right of use asset and lease liability. Another item to think about or consider are modifications to underlying leases. So if you're currently entering into a lease agreement and you decide to modify that to lease additional property or cut back on the property or the assets that you are leasing, there are certain rules and steps that you need to go through to determine whether or not you have a new lease or a modification of an existing lease, and that will affect the underlying accounting as well. Related party leases, I found interesting 180 that the GAP took here. Underneath the old standard, it was substance over form. So it didn't matter how those related party leases may have been written. It was what was the underlying substance behind them. Underneath this new standard, it talks more about legally enforceable terms. So thinking through what kind of related party leases you have in effect currently is going to be important as you think through the new lease accounting standard. Lease inception and lease commencement may not be a big deal for many of you, but the idea behind when the lease actually starts does change, and there's slightly different definitions from the old standard to the new standard as to what the starting point is for leases. And then as Jamie alluded to, this new standard is going to impact your financial ratios and debt covenants. So, for example, you're going to have a long-term asset for the right of use asset on your asset side of your balance sheet. On the liability side, you're going to have a current portion of the lease liability and a long-term portion. So that can impact your current ratio, your debt to equity ratio. So if you're if you're currently in a situation where you're always close to tripping your covenants, or you want to talk to your bank sooner rather than later to make sure you address some of those some of those items, but just some things to consider. Other topics, and again, we didn't cover lessor accounting in this presentation. It's largely similar to what it was before, but there are some nuances and differences. If you do have any questions, and you are a lessor that's on the call today, feel free to reach out to Jamie or I, and we're happy to talk to you a little bit, or put you in touch with actually some other experts on the lessor accounting side to help you think through how this is going to impact you. Sale leaseback transactions and leverage leases. Those are ideas from the old standard that have some grandfathering, and the underlying accounting has changed underneath the new standard. Subleases is another area to consider. So if you're that company in the middle that's leasing from a lessor and then subleasing the space to somebody else, how do you account for that? Because you are the lessee and lessor underneath two separate contracts. Is it two contracts? Is it one? Again, there's additional information that would take a lot of time to go into today. And then ultimately, lease terminations. When you decide to terminate a lease, what's the if you were terminating an operating lease underneath the old standard, there's nothing really to consider. Under the new standard, you're going to have an asset and liability that you need to retire, and there's a certain way to go about recording. Potentially there's a gain or a loss depending on what transpires with that underlying transactions. As we enter into the last two slides, I want to talk on the last point in Jamie's objectives, right? So how do we all prepare for this? First, our recommendation is to become familiar with the standard. This presentation is meant to be a good jump off point. Cohen will also be releasing monthly blogs. I think Jamie's starting next week for the first one. Maybe within the next 2 weeks we'll get the first one out, and then we'll have one for each of the next 6 months that'll help you, that'll talk on different topics, give you ideas of different people within the company to reach out to if you have specific questions regarding those. But the more information you can obtain, the better. Inventory your current leases. What resources are needed. So do you have a good handle on all the leases that your organization currently has in place? You may have all the information gathered for financial statement purposes, but do you have the updated? I know when I'm asking my clients, hey, this lease agreement is from 2002 and it's been renewed 3 times, or do we have all of the current and right information and lease terms? So making sure you gather all that information, and if you do have over 50 leases, what resources are needed on your side to really make sure that's an efficient process. As you look forward to next year in this implementation, plan for future leases and amendments. Get processes in place who can approve and authorize lease agreements that you entered into. If you do have related party leases, because it's now form over substance, make sure you're thinking through and getting those leases updated. And then, as we discussed, I think several times, making sure you're talking with your bank and implementing those or jumpstarting those conversations as necessary. So, kind of in closing here, how Cohen and Company can help. Everything that we mentioned, there are a lot of nuances behind it all. Cohen is able to help in many different ways. You feel free to start, if you're currently a client, start with your engagement team. There are a group of us, Jamie and I head up a group of subject matter experts in this field, and we can definitely jump in to help you with any of these items, from lease classifications to identifying whether or not you have embedded leases in some of your contracts, software selection and or implementation, and formal documentation of lease policies, and overall evaluating other areas of your business if there are any. So we know this hits home on a larger basis than just the finance group. It can affect others, especially if you have a lot of leases within your organization. So again, something you want to consider, and feel free to reach out to us if you have any information. So I'll leave a little room for questions here. Our contact information is up on the screen. And I only see one other question currently. And are there any software providers recommended by Cohen and Company? So currently we do not have a designated software provider. We actually have a consulting team that, depending on the complexity of your leases and how many you have, we have a team that can really help you determine what the best software out there is for your purposes. And we're more than happy to talk with you further about that if you want to, if we want to reach out.
I think that was the last question in the queue, Brian and Jamie. So thank you to, we're finishing up just a few minutes early. Thanks to everyone for joining today, and a special thank you to our presenters, Jamie and Brian. We hope you were able to gain some valuable insights, and we hope to see you next week for the second program in the series, an update on the Employee Retention Tax Credit, eligibility, and tax benefit, next Tuesday, July 20th at 12 noon. So thank you, everyone. Thanks, Jamie and Brian.
All right. Thank you.
Thank you. Have a good day.
Thank you.